Good afternoon and welcome to the Trident Royalties PLC Investor Update. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll. And I would now like to hand you over to CEO Adam Davidson. Good afternoon to you.
Hello. Thanks, everybody, for joining the webinar. Let's see. Just to kick things off, most of you are probably aware, Trident Royalties, we listed in 2020, mining royalty company looking to build out a diversified portfolio of royalties. We listed in June 2020 with having secured one royalty on an iron ore asset that's been paying us quarterly since that time, but have grown now to include a total of 21 assets, 13 of which are cash flowing and very much broaden the diversification of the portfolio. So with that brief introduction, perhaps we'll take a step back. For those that aren't too familiar with royalties, we'll go through that and specifically what Trident's doing that's a little bit different from most royalties in the mining space.
Great, thanks, Adam. So I'll just touch on why royalties offer a different and superior exposure to commodities. So royalties that we hold, we typically earn a small percentage of the top line revenue from a mining operation. That's normally 1 or maybe 1.5%. And the real benefits of the structure when compared to mining equities or holding a physical commodity ETF, that we obviously have leverage to the upside in commodity prices. We get swings to the upside. We benefit from that on the top line. We're also exposed to exploration upside and expansion. So when an asset, moves through into production and then the plant size gets increased or down dip extensions get drilled, we're fully exposed to those things as a mine moves through its mine life. But the real special sauce in the royalty sector is that we're not exposed to capital costs or operating costs. So I know we've seen a lot of inflation through the sector in the past couple of years. When that occurs, the margins at some of these operations get squeezed, and obviously the operator and their returns get pushed down. But our return is undilutable. It's a top line interest, so we maintain that top line royalty interest, and we also don't get diluted through the funding process. So mining companies often have to raise multiple rounds of equity financing to see a project to completion, whereas when we've invested and got a top line royalty exposure, that doesn't change with equity dilution. And a couple of the other benefits of our model are it allows us to be much more diversified. So we're a relatively small company, a sort of $135 million market cap. We've got 21 separate assets, across continents, commodities, and with different operating partners. If we were a mining junior, we'd probably have one project, maybe one secondary project that we're working on, and we'd be very concentrated. So our risk profile, therefore, is much lower. And we also sit senior in the capital structure. So at times, assets come online, offline, may go through a bankruptcy process. Typically, in most common law countries, the royalty would stay with the land area and could pick up again if a new operator took the project over. So that's just why royalties offer a very different exposure to mining and commodities than some of the other products out there. And just to illustrate the sort of success of the model in the past, you'll see the chart on the right side there is of Franco, Wheaton, and Royal Gold, the three behemoths of the sector in North America, and they've been going in their current form for about 15 years, and you can see the strong outperformance they've had when referenced against the gold bar, which is the GDXJ, the US Gold Producers Index. So that's royalties. I'll just touch briefly on our approach as Trident. We're slightly different to many of the royalty companies out there. So if you look at the whole mining sector in the top donut chart on the right, it's broadly in thirds, a third precious metal, a third base metals, and a third bulks, and increasingly battery and other minerals. But when we look at the royalty sector, it's about $65 billion in combined market cap. The bulk of that, over 90%, is focused on precious metals. So there's a few historic reasons for that. The sector grew up in North America. That's a very strong gold market. So you've got most of that combined market cap chasing precious metals, and only 8% is focused on non-precious. So that's why we've targeted a strategy of being commodity agnostic, but certainly with a slight bias towards trying to build up non-precious assets where we see a lot lower levels of competition. So with that, I'll just hand back to Adam just to touch on some of the acquisitions.
Yep. This share price chart, I suppose really the key takeaway here is the deal velocity, because I think many investors upon IPO understood that it's a very intuitive strategy. And the initial question we frequently received was why is nobody else doing this? And to be fair, there are other parties that are doing this, but the vast majority of our peers focused on precious metals. So the natural question is, are there actual royalties out there to be acquired and aggregated into a diversified portfolio? And upon listing, we'd only secured one royalty, so it was a fair question. I'd like to think that we're through the proof of concept phase, as this chart highlights. We've been very active over the last 3.5 years, done a number of acquisitions, and as I said, built the portfolio up from one asset to 21 assets. So very rapid progress, and I think have demonstrated that opportunity set is out there. Now from here, we can sort of continue to grow and scale the business. A brief snapshot now of the portfolio, and we'll touch on some specific assets on further slides, but certainly won't drag you through all 21 assets. A couple key things we like to highlight here as being important to our strategy. The first off, you can see in the top right box, 60+% of our NAV per analyst consensus estimates is in Canada, US, and Australia. Our shareholders obviously don't want us to become an emerging markets type of offering, so we want to keep that proportionality. That said, we will go further afield for the right assets and the right return profile. Naturally, we'll price in jurisdictional risk and the returns required to do a transaction. But by and large, want to get good quality defensive assets in good jurisdictions. The other thing worth flagging on this slide is we note them here as select royalty partners. These are actually some of the operators of the assets. Worth flagging that the bulk of our acquisitions to date have been on existing royalties. We have done some primary financings where we're actually funding the mining company directly, but all the names on, or sort of the majority of the names on this list on the right side do not need capital from Trident. They're by and large sort of mid-tiers and a couple majors. So many people assume because we're a junior royalty company that we must write royalties to junior-led projects, which are inherently higher risk, when in fact almost the complete opposite's true. The bulk of our portfolio is led by mid-tiers. So good operators like Equinox Gold, sort of plus $1 billion market cap, strong balance sheet, good access to capital. Mineral Resources is an $11 billion company, B2 Gold, $4 billion. To be sure, we've got a couple majors that I mentioned. We've also got a couple juniors, but heavily weighted towards good, solid mid-tier operators.
Okay, just on this page, it just shows our revenue profile. These are the analyst forecasts. And as you can see from a base load where we sit today, sort of $11-12 million of revenue, there's rapid growth through to 2026. I think one of the key points to highlight here is the bulk of that growth comes from assets that are already producing today. So it's ramp ups at many of the operations. And then the light sort of blue-gray bars you see there, that's ramp up in revenue from assets that are already in construction and in many cases very near to production. So sort of the underpinning of this chart isn't projects that are far away in the future. They're very much things that are either producing today or very near to being delivered. For example, Greenstone, the Equinox mine in Canada, that's slated to come online the first half of this year. Preciosa, they're imminently starting production from that operation. Dandoko, we're still waiting, but the back end of this year, early next year. So these assets are moving along at a rapid pace. So that gets us to revenue of around $25 million by 2026. And even in that year, we've only got sort of half a year of Thacker Pass production there. So going forward, as that asset ramps up, we have the sort of the bar fading off in 2027, but there's certainly a lot more growth to come through beyond what we see in 26. Just one other point, we obviously have a couple of one-off payments, 13.2 million from Thacker that's slated for 26, and the Preciosa milestone payment, which should come through in 2025. So that again adds materially to our revenue and our cash balance. And just touching quickly on the balance sheet. So this chart here just shows the evolution of our various debt facilities over the last 3 years. So from starting with a $10 million facility with Tribeca, which was a 10% margin, we've subsequently refinanced and lowered that cost of capital through the facility with Macquarie. And then, as you may have seen on Monday, we completed a new facility with BMO and CIBC. For those that don't know those institutions, they're two of the large Canadian banks that do a huge amount of work in the resource sector and work with a lot of royalty companies in North America. So the good thing is our new facilities with a couple of very strong partners, and it's also at a much lower cost than the previous facilities. So we're going to be paying SOFR plus 2.5% to 4.5%, depending on leverage. And I'd expect we'll probably be sort of in the mid to the lower half of that range for most of our operations. And the other key benefits to the new facility, it's a revolver, so we can draw it down and pay it back, and we don't have to suffer a high carrying cost of having a large cash balance on deposit that we're not utilizing. And we can also extend the facility. It has a $20 million accordion feature, so we've got that in our back pocket should we see larger deals or we need further firepower for growth. And just moving onwards to the valuation, as you can see there, the chart on the left shows our price to NAV ratio. As you can see, we're at the bottom side of that graph, trading about 0.5 times NAV. Typically, over the last year, we've been at sort of 0.7 to 0.8 times. So obviously, a bit of weakness at the back end of last year, and we currently sit down near some of our peers. I think the main rationale and reasoning that we are probably lower rated than some of the slightly bigger companies is we've still got a bulk of our cash flow or our asset base is in developing assets. As we talked about on the previous slide, a number of things in construction that are coming through. And we'd certainly expect as those assets reach production and start cash flowing, we'd see the discount to NAV unwind as we go through the next sort of 1 to 2 years. And also as we move forward, the NAV actually increases as we get nearer to those cash flows. So the discounting sort of factor becomes less.
This slide highlights our NAV per share, so our net asset value per share per analyst consensus estimates by commodity. Obviously, heavily weighted towards lithium at the moment. We'll talk to one of our key assets, Thacker Pass, on one of the later slides, but the bulk of that is attributable to that specific asset, followed by gold at about 30% and then copper at about 20%. I think the key thing really to highlight here is, as I mentioned, when we initially listed, we had secured one iron ore royalty. It now falls into that sort of 2% bucket with regards to our NAV per share. So highlights that the objective of Trident is to broaden and diversify our commodity exposure. Ultimately, we want to get to the point where a single share in Trident provides sort of broad, diversified exposure to the sort of full breadth of the mining sector. Given there's much more competition on the gold side, I think we've been pleasantly surprised with the amount of gold exposure that we can get. Probably a reasonable probability that gets diluted down a little bit over time, given there's 20 plus gold royalty companies chasing gold royalties. But really the prerogative for us and the opportunity that we largely see is outside of precious metals. It's in base and battery metals. So, the real objective is over time to add commodities like nickel, zinc, rare earths, graphite, and so on, and provide a full sort of comprehensive offering. Now, that's always going to be a work in progress, as it has been since day one, but I think we've made very good headway in that regard. I mentioned I won't drag you through all 21 assets, but worth touching on a couple of them, and I'll spend a bit of time on Thacker Pass. For those that aren't familiar, it's an important asset. As I said, drives the bulk of that 40% of our NAV attributable to lithium. But also it's a good example of sort of the general strategy and how we source these acquisitions and how we price them, the return hurdles that we're looking for. But maybe first off, touching on lithium as a commodity, it's seen quite a bit of volatility here in the last kind of couple of years. I think in our view, that's largely down to just the fact that it's grown from a pretty modest production profile and supply demand dynamic. to being much more in demand, obviously driven by EVs and battery storage. But the supply-demand dislocation is going to cause volatility until it grows to a size and scale such that it's like other exchange-traded commodities. Now, to put that in perspective, there is a little over 800,000 tons of lithium mined last year. Copper is north of 25 million tons. So it's still very much a developing commodity in that regard. Now, what's really driving that, as you can see in the top chart, is the uptake of EVs and hybrids. That's one of the probably the most important facet. As you can see, sort of exponential growth in that regard. Targets in the US are 50% uptake by 2030. Canada 60%. California is 100% by 2035. I don't doubt that there will be stutter steps along the way. Some of those targets may slip quite easily, but I think most people on this call probably agree that there's a very clear direction of travel. What the lower chart on this slide then highlights is the fact that of all sort of key battery designs, lithium is a core component of all. Nickel can be engineered out. Cobalt's increasingly been engineered out. Same with manganese. But you can't make a lithium ion battery without lithium. And lithium solid state batteries in most designs require significantly more lithium than lithium ion. So we like exposure to the thematic in terms of getting lithium, particularly into the portfolio. But in particular, we like our exposure to lithium via Thacker Pass. So this particular asset is an existing royalty that was acquired. I'd mentioned previously that the bulk of our acquisitions have been on pre-existing royalties that we acquired from third parties. So we didn't finance the operator, Lithium Americas. We bought this from a private equity fund that had written the royalty back in, I think, 2011. Now, as a closed-end fund, they need to monetize their assets. They can't hold them forever. So we knew the existence of the royalty. Really, the catalyst for us was in January 2021. The operator received the final key federal permit for construction. And then later that same week, raised $400 million in an equity raise towards construction. So we acquired 60% of the royalty at that point in time, which was all we could do with our available share capacity at the time. Otherwise, we would have bought 100%. The return hurdles we were targeting was a mid-teens post-tax IRR. So we were specifically on this one, we were modeling a 16% IRR. Important to highlight that 16% year after year for a 40-year initial mine life. A couple things happened subsequent to that are positive for the royalty. Firstly, the operator announced a planned increase in the production profile, which, as Richard mentioned earlier, one of the key benefits of royalties. So the CapEx commiserately went from $550 million in their pre-feasibility study to $2.3 billion in their definitive feasibility study published last year. A lot of that to do with inflation, but obviously part of it to do with the bigger planned production profile. We're not exposed to that at all. We get an undilutable 1% of their revenue in perpetuity. So we're more than happy to see the uptick in plant production. The other facet is obviously lithium's been on a wild ride here, touched up to 80,000 in 2022, but we had been pricing at a long-term price of 12,000 per ton. So even with the volatility, the long-term consensus price for lithium is in the low 20s. So anecdotally, we flag here that at $25,000 lithium price, this royalty to us would be generating just north of 20 million a year. And at those highs we saw in 2022 would be close to 70 million a year. Invariably over the 40-year life, we're going to have some real banner years. There'll be some leaner years. But with this asset being one of the only assets that we expect to be producing out of the U.S. The U.S. doesn't domestically produce really any lithium. And this asset is in construction now as we speak. It's a strategic asset. Not only is it a sort of globally significant tier one in terms of size and scale, but it's in the right jurisdiction because most lithium today is either produced or processed in China. So there are strategic reasons that both the Biden and Trump administrations were very supportive of getting this asset into production. The next kind of key catalyst on Thacker Pass is the operators flagged they're expecting a Department of Energy loan as part of the Inflation Reduction Act, which this lithium qualifies for with regards to tax credits for the off-taker. That's expected this quarter. Lithium Americas continued to guide to that as recently as last week that they expect to see that loan finalized. Now, as the royalty holder, that doesn't impact us too directly. Obviously, we believe the project is going to be financed regardless, but would be very pleased to see effectively the bulk of construction capital being funded by the U.S. government. It also provides the operator with very low cost of capital, which provides some flexibility for them. The only other thing worth mentioning is General Motors is the off-taker. They're also going to be the largest shareholder in the project, the largest investment by an automaker directly down into the mining side of securing these raw materials. So a very strong endorsement for the project. So tier one project. Had it been Nevada Gold instead of Nevada Lithium, we'd be competing with our multi-billion-dollar market cap peers to secure an instrument like that. But as a non-precious royalty, that's, as I said, really where the opportunity set lies, and a good example of the kind of deals we'd like to build around the portfolio. Flipping to precious metals, we won't spend too long on this one. Our gold offtakes, I think, are very quality assets that provide the bedrock of our revenue to date. We saw that tick up 12% year over year. As Richard alluded to, Greenstone will be turning on in the first half of this year, so we see that that's likely to continue to increase over the course of 2024. The Sugar Zone offtake, operated by Silver Lake, announced overnight that they've completed 47,000 meters of drilling on a total nearly 100,000 meter drill program. That's a very significant amount of drilling for an underground mine, and that's expected to turn on this year as well. So in general, between assets that are either ramping up or turning on, we expect to see that portfolio continue to grow. One of the assets that we bought last year, the La Preciosa silver royalty. This was, again, an existing royalty acquired from Core Mining. So a good mid-tier mining company held this royalty as a non-core asset, happy to monetize it when they had a capital need. The operator of that asset now in Mexico, Avino Silver and Gold, announced in January that they'd secured the final key community agreement to commence production. So they intend to start processing stockpiles through their existing mill immediately, effectively, and then fresh ore before the end of the year. So very pleased. Precious metals royalties have a huge value uplift as they go from development stage to production. So to have acquired this in May last year and hopefully see some production imminently from the stockpiles, albeit it will be small, but then from fresh ore before the end of the year, that's going to be a really good event for us. And 12 months after first silver production, we'll receive a milestone payment of $8.75 million, which we're penciling in for 2025, and would see us immediately into profit on that transaction. We acquired it for $7 million, with another $1 million due once we receive the milestone payment in full. And then maybe just flipping to copper, it's a commodity that we really would like to get more exposure to. Our most recent transaction was on the Antler project in Arizona. I highlight this one because I think it's a good example of the kind of market that we're in today, where the operator of this asset, their share price had come off quite a bit over the course of last year, went from being very lukewarm about putting a perpetual royalty over their project to increasingly open-minded as the idea of raising equity to fund drilling and study work became less and less palatable. So it highlights the opportunity set in this market. We've got the potential here to put royalties on very good projects that in a more buoyant market would probably be unlikely to be able to do. In this particular case, on their most recent study, it's a good 13-year mine life at 33,000 tons a year of a copper equivalent production in Arizona, sort of a fantastic mining jurisdiction. We'd like to do assets like this all day long if we could. They continue to drill it out. Ideally, we'd like to see this one get a little bit bigger. If it gets closer to sort of the 50,000 ton a year production profile, that's a very solid copper project in a good jurisdiction where copper is classified as a critical mineral. I'm very, very happy to have made that acquisition and expect their pre-feasibility study here imminently.
Just on the catalysts, I know we've touched on a number of these already. Certainly, we had a very busy back end to 2023 with a number of new deals delivered, capital returned on Cooley and Mimbula, lots of progress across the offtake portfolio. The main near-term things are the Thacker Pass DOE loan, progress that's going to be made at Antler, and then those production announcements or production ramp-ups that we'll see at the La Preciosa and Dandoco, and then at Greenstone from an offtake perspective. And certainly as we move to medium term, the next sort of 1 to 2 years, there'll be lots more news from Thacker and a number of the other assets as they move through construction and kick off and start paying cash flow.
Just on ESG, I think a couple things to note here. Obviously, we're one step removed. We're not the project operators. That said, as part of our due diligence process, it's an important facet. We're in the process now of sort of refining our internal policies. This is important for a number of reasons, obviously for the right altruistic reasons, but also to tee up opportunities for Trident in the future. If we wanted to do a dual listing or step up to the main board in the UK, there are certain minimum requirements and thresholds that need to be met. So we want to stay on the front foot and make sure that we're managing that appropriately.
And just touching on the balance sheet and the cap structure, obviously we've talked about the debt. So currently net debt's just over 20 million. So we've got a reasonable amount of firepower to do further deals pre the accordion feature of that debt facility. And the pipeline's pretty strong. We've got a lot of assets that we're looking at. And just from a markets perspective, our shareholder list is the same, reasonably strong. So we've still got the original Australian shareholders, Regal and Lim, at the top of the register with about 20% between them. And further down, we've obviously got a number of blue chip UK names like Ruffer and Marty and BlackRock. We've got a number of other very well-known UK institutions just a bit below the 3% reporting threshold. So very strong on the register side. Still covered by our three analysts with target prices from sort of 75 up to 90 pence.
I think that brings us to the end of the presentation. So I'm happy to pivot to questions from here.
Adam, Richard, that's great. Thank you very much indeed for your presentation. I will now bring your cameras back up. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the top right corner of your screen. While the company take a few moments to review those questions submitted today, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via our investor dashboard. Adam, Richard, as you can see, we have received a number of questions throughout today's presentation. And Adam, if I may now hand back to you and kindly ask you to read out the questions, give responses where appropriate to do so, and I'll pick up from you at the end.
Yep, sure. So starting at the top here, the first question is, do you think the average UK investor understands the royalty model? I think it's increasing, to be sure. I mean, Ecor Resources has been listed here for a while, so I think they've done a good job of spreading the word about royalties. Of course, we see music royalty companies. Duke Royalty does non-mining, non-resources royalties. So I think the model's starting to percolate through to investors. But to be sure, there's more education to be done. In North America, there's, as I mentioned, north of 20 listed mining royalty companies. So there's a dual benefit and also a downside. There's more education here, but there's also less competition for investor interest. And for mining royalty companies in our market cap range, sort of the 100 to 200 million market cap range, we stand out as having the best liquidity. And I think that is down to the fact that there are fewer options for investors to choose from in London.
Great. Just the next one. What commodities are strategic investment priorities for Trident moving forwards? I think we've touched on that through the presentation. Certainly at the moment, we're weighted towards lithium, gold, copper, and then a smattering of other commodities. We'd certainly like to keep increasing that diversity. We're very keen on base metals. So we like copper, and we'd certainly like to increase our exposure to copper, but also other metals and some of the minor commodities like rare earths and graphite and zinc. So I think diversity is the key. But certainly from a capital allocation perspective, we're very much commodity agnostic in that the best deal wins. So we're not just completely focused on one commodity. We're still very much focused on return, but hopefully those two factors will blend together.
Next one is, given the importance of Thacker Pass, what impact do we think the collapse in lithium prices have had on Trident's share price? I think it would be silly to say there's no impact whatsoever. I think the wind maybe came out of the sails of the lithium space. So for people that don't track lithium price, it had gone from 10,000-12,000 a ton in 2021, 2020, kind of roaring up to 80,000 a ton ever so briefly, but was sort of north of $70,000 a ton for a good chunk of 2022, and then now has sort of dropped back down into the mid-teens. As I said, for us internally, the way we view it is we use long-term price. Thacker Pass doesn't turn on until the second half of 2026, so spot prices to a certain extent are irrelevant outside of how they impact sort of supply-demand dynamics and which mines are sort of moving towards construction. But I think investor sentiment, of course, there's some impact there. That said, most institutional investors and most retail investors, I think, are investing on fundamentals, particularly given we're a diversified royalty company. So although we've got a fantastic asset in Thacker Pass, there is a lot more than just Thacker Pass. And the intent is to continue to diversify the portfolio, as Richard said. So it's probably had an impact, but probably less impactful than just broader equity markets softening over the last year.
Sure. Next question. How many negotiations for royalty acquisitions are under NDA, and how many of the negotiations are at an advanced stage? It's always tricky talking about the pipeline. We probably see probably a couple of opportunities every week, so roughly 100 in the year. We're certainly not working on that many deals today, but these processes can speed up and slow down extremely quickly. So some things move through the stages of DD quite quickly. Other things have a gestation period of years. At the moment, I'd say we've between 10 and 20 assets on the list. Some of those are under NDA, maybe not all of them. We've got a couple that are moving towards an advanced stage, always with the caveat that they could race to completion or may fall away for whatever reason.
See, the next one's, are you going to focus on acquiring currently producing and near-term producing royalties that would likely have a significant impact on the currently depressed share price? The reality is we obviously want more cash flow, and the sooner that cash flow can come, the better, with the offsetting factor being the fact that that producing royalties cost more. Obviously, they're de-risked once they're in production and cash flowing. So you have to pay a higher valuation to acquire those assets. And the further you get away from production, the cheaper the assets are. So it's a bit of a balancing act. We come back to Thacker Pass as kind of an ideal example because we bought that in 2021. It's going to be in production anticipated by 2026. I think the reality is assets in that sort of 3 to 6 year timeframe away from production, that's kind of the sweet spot from a valuation perspective. Usually it's advanced enough that you can see that it's maybe not all the way through permitting, but getting through the process. They'll have published studies, the sort of size and anticipated scale of the royalty or of the project on a whole. And most importantly, you have kind of clarity and line of sight to what cash flow will look like. For something that's earlier stage than that, it gets much, much more opaque, but you pay less for it. For things that are in cash flow, there's less sort of uncertainty there, but you pay for that as well. So it's a matter of sort of striking the right balance. And these things can be found. I flagged our first royalty as an iron ore royalty that we bought. It's been operating in Australia, paid us $500,000 last quarter. We bought it for about 4.1 million US, which returned to date about 5.2. Still producing. The operator recently announced they're going to commence some drilling on our tenement area. So these things can be had for value. It's just a matter of kissing a lot of frogs to find the right deals.
Right. Next question. Are there any risks that you foresee in your projects, something like the recent landslide and cyanide incident in Turkey? Certainly, there's nothing that we're aware of. And as Adam mentioned earlier, we take ESG very seriously, and it's a very key part of our new investment process. So to the extent we can, if it's a primary financing, we would always go to site, and we have technical consultants review these things. So it's obviously something we monitor very closely. There's certainly nothing we're aware of within the current portfolio that has any of those sort of issues, but it's certainly front of mind as we look to invest capital and continually monitor our assets where we have those auditing and site visit rights.
Next one is, will your future strategy remain diversified across metals, or do you see focusing on one commodity over others? At this stage, and we may have already sort of largely answered this one, but at this stage, the objective is to continue to remain diversified. But in reality, the most accretive deal wins. So returns kind of trump everything else. Now, it would probably be fair to say we're not going to rush out and try to add more lithium. That's lower on our priority list. We'd like to broaden the commodity exposure of the portfolio. But yeah, as it stands, strategy is unchanged. We want to remain diversified and with a focus on returns above all.
What's your view on gold prices for the next 2 years? Well, I'll give my view, and then Adam can chip in on this one as well. So we're certainly bullish over the next 2 years. I think the price has held up remarkably well over the past year, given the US rate cycle we've seen. I know there's lots of debate, and it does bounce around a little bit at the moment as we're waiting for that pivot and cut of rates in the US. But I think when we start seeing that come through, coupled with the fact we're seeing very strong levels of demand from emerging market central banks, we feel the gold price should be pretty well bid and pretty well supported through the next couple of years.
Yeah, I mean, in terms of my view, if we actually flip back to the precious metals slide, I think fundamentally agree with everything Richard said. But I think that graphic, in many respects, encapsulates a lot of my response. I think as we see these sort of broader fiscal strategies play out, I think there's no doubt that you're going to see gold continue to track alongside with money supply more broadly, inflation in the U.S. It'll always sort of dip below, dip above, but as you can see, there's a very, very strong correlation there. So I'm happy to have some gold exposure in the portfolio. Let's see. Next one is the Chinese economy suffering deflation and lack of demand and inward investment. How do you think this will affect resource demand and pricing? This one's a little bit difficult to succinctly tackle, just because it's almost a commodity by commodity analysis that you'd have to go through. The impact on iron ore is going to be different from the impact on lithium, for example. So I won't drag you through that. Other than to say it's something that we're very conscious of, and above all, when we look at assets, I touched on the operators being good quality mid-tiers. Maybe the thing I didn't touch on is we want assets that are defensive assets that will survive cycles. Because if it's not the Chinese economy slowing, it's going to be something else. And what you don't want to have is a portfolio full of assets that are in the fourth quartile of the cost curve. What I mean by that is they're the highest cost assets in operation, because what happened is prices dip into that cost curve. The more expensive operations to run are the first to shut down, obviously. And you don't want to have royalties that are sort of dipping in and out of production, because they're those sort of swing marginal producers. So, an asset like Thacker Pass, per their DFS, using it as an example, it's $6,700 a ton per lithium. So, even though prices have dipped to the mid-teens on paper, and we'll see when it actually gets into production, but on paper, that's a very defensive sort of first, second quartile asset. A lot of operations need to shut down before that asset does so. And I use that one as an example, but I'd say it largely applies to almost the entirety of our portfolio. And that's a very important aspect of our diligence more broadly.
Next one. Generally speaking, do you have to hunt out deals, or are you approached more by sellers more often than not? I think the honest answer to that one is it is a blend. We certainly, with bigger transactions, sellers may at times appoint advisors or investment banks, so they would sort of scour the landscape and approach us. But there are many deals where we've either initiated the conversation with a royalty holder or a mining company and offered them finance. So it's a blend. I would say as the company gets bigger and we do more deals, our brand name is more well known in all the major resource markets in Australia, in Europe and Africa and North America. So increasingly, we do see more things come to our door than would have been the case sort of 2 or 3 years ago. But we are actively out there hunting, and I think often things that are somewhat off the beaten track or that you can help uncover and unlock are where you can see the best value.
Are you likely to be affected by the Mexican government stance on open pit mining? We don't expect so. Obviously, it's something that we're monitoring pretty closely at this time. I think with something like north of 500 operating open pits in Mexico, it seems pretty unlikely that there's going to be a sweeping change that shuts down all those operations. So we've got a gold offtake on Los Filos, for example. That's a pretty significant mine in its region. So expect that to be protected. La Preciosa, I mentioned, is intending to start commencing stockpile processing before they go into fresh ore. That's an underground mine. But more broadly, this jurisdictional style analysis is important for us. whenever we do a transaction, sort of, and again, highlights why we like to have 60+% of our NAV in sort of more predictable mining jurisdictions.
At what point would you consider stepping up to the LSC main board? That's certainly something that we will think about in the medium term. It's not something that's a near-term ambition or goal. I think the AIM market's been a pretty good home for us from a liquidity perspective. We talk to lots of institutional shareholders, and it's not something that particularly holds them back from investing. So I think as the business grows and becomes a sort of a mid-tier royalty company, we could look at the main board. We could look at listings in North America. We're currently sort of making a first step towards that with the OTC listing in the USA. So we're marketing that through this year, and we'll see how the take-up is there. But we sort of actively monitor alternative listings, but certainly it's not a near-term change that we'll make.
The next one is, could we have an update on the Sonora legal issues? So for background, for the people that aren't familiar on this one, we've got effectively what amounts to a synthetic option to acquire half of a royalty over the Sonora Lithium project in Mexico. So that transaction obviously hasn't been affected yet. We announced just this week that we've got until we extended the execution date to be able to do that to the end of 2026. So, and there are two kind of legal issues on that one, which is why we structured it as an option effectively. The first one is the validity of the royalties being challenged in court in Alberta. The appeal on that is expected to be heard this year with obviously a ruling thereafter. So in that roughly 3-year timeline we have on the option, we'll see some kind of resolution there. Obviously, from our review, we believe it's going to fall in favor of the royalty holder. The second issue that surfaced last year was Mexico was making rumblings about nationalizing lithium projects. In particular, it was meant to be new issuances of licenses for exploration, but then they canceled the licenses that comprise the Sonora project. The project is operated by Ganfeng Lithium, so one of the big multi-billion-dollar lithium players in the space. Their most recent public disclosure on that was that they had been in discussions with the Mexican government leading up to the cancellation. I think probably fair to say that surprised them. This is something that we've seen Mexico do in other sectors. Natural gas pipelines, for example, sort of threaten nationalization or actually carry through with it, and then it reverts back to the operator of the asset once they've extracted some value, free carry, larger government royalties. I think from our perspective, this is a very complex project to build, large CapEx ticket as well. So I think Ganfeng is the likely builder of that project. We suspect. I don't think that the lithium exploration entity that the Mexican government stood up is the likely party to build this. But again, over the next 3 years, we expect to see some resolution there. I think if Ganfeng is going to get their hands back on the project, then we'll know before that time elapses. So, it's important. Obviously, there's no real upside associated with Sonora baked into our share price, but it is reasonably important in the sense that it's got sort of similar size cash flows to Thacker Pass, sort of slightly smaller project, but a larger royalty rate by 50% for us. So yeah, is that potential real upside scenario if both things fall in our direction. So something we'll be monitoring, obviously, for the next few years.
Okay. Do you have any profit forecasts for later years, say year ending 2026? We don't publish formal guidance for revenue or for profits into future years, but one thing I would say is we showed you some of the analyst figures in the presentation for revenues. From a cost perspective, the business is very scalable. We have 6 employees. We have a pretty small G&A of about $4 million a year. If the debt was fully drawn, interest would be about $2.5 million a year. So that gives you a flavor for our cash operating costs, if you can think of them like that. They may not be the costs that you see on the P&L, with that'll include amortization and other factors. But what that does sort of show you with those rough figures is that as revenue expands to sort of $20 or $25 million, we'll certainly start generating, some reasonable levels of free cash flow, which we can reinvest in further transactions as we move towards the middle of the decade.
Let's see, the next one is, given the current downward trend in lithium prices, does the team see any risk in the operation and performance under this trend. Not specifically. I think a couple aspects there. Obviously, as I said, the bulk of our lithium exposures via Thacker Pass, which the operator noted they spent nearly $100 million last quarter, and that's intended to accelerate over the course of this year. Yeah, a couple of nuances to Thacker Pass. As I said, there's not much domestic lithium production in the U.S. Of that 800,000 plus tons produced last year globally, sort of 3,000 tons came out of the U.S. So we don't have a secure source of supply of lithium, which is why this asset is such a high priority for sort of both administrations from respective political parties. And we know that the process to sell the offtake for Thacker Pass was incredibly competitive. I think pretty easy to see that by the fact that that General Motors is putting in $650 million in an equity subscription just to be able to buy the lithium at market rates. That's a very aggressive position. You know, this lithium is expected to qualify for Inflation Reduction Act tax credits. General Motors has said it will help them build up to 1 million EVs per year. So it's a critical asset in many respects. And because of that, I think probably operates on a slightly different pricing dynamic. And I don't think, I said it was sort of a first or second quartile asset. There's that, but I also think there's some qualitative elements around it as well that mean it's a particularly defensive asset. So no, we don't see any immediate risk to the business in that sense.
Okay. Have you considered trying to get exposure to uranium, which looks to have good long-term potential? We have looked at the odd uranium deal in the past, and not at present. One thing I would say about uranium, whilst it certainly does look interesting from a medium to long-term perspective with strong demand, certainly out of China and other places, it's pretty tricky to get exposure to as a sector. There aren't a massive number of uranium mines globally, and they're quite concentrated in Russia, Kazakhstan, and some of those controlled by the bigger North American companies like Cameco over in Canada. So we don't see that many junior uranium projects seeking finance. That probably will change as, if the current pricing levels continue for, months and then years. I'm sure we'll see more exploration and development activity. So it's something we'd certainly look at, but let's say quite a small and tricky sector to get the right exposure to.
So the next one is, when do you foresee a maiden dividend? Maybe we're allowed to flip to the revenue slide. We show that analyst consensus forecast for our revenue. We only show it through 2026. Probably worth flagging that 2027 plus. We kind of have it fading away into the future. But as I alluded to, Thacker Pass alone, once fully ramped up at long-term consensus price, pays north of $20 million a year. So that's almost the entirety of that 2026 bar. So then you kind of layer everything else on top of that. And we haven't spoken about it as much, but assets like Antler, Mimbula Coppers and Ramp Up, Dandoco Gold, La Preciosa we've touched on briefly. There are other assets within the portfolio. So I think most analyst models see us sort of towards the end of the decade, 5-ish years away, kind of being more in the $40 to $50 million range. So naturally, we hit an inflection point where we can start issuing a meaningful dividend, and it doesn't constrain our deal capacity because we're still very much a growth company. This is the revenue profile we built in the 3.5 years of being listed. What we don't want to do is sort of pivot to just paying out all of our cash flow and halt the growth and sort of become a wasting asset. So we've got to make sure that we do it at the right time is really what it boils down to. We're conscious dividends are important. As a shareholder, I'd like to see a dividend as well, and I know it'll be a good day for the share price. So as we stand today, I think we need to see some of these assets sort of de-risked and into cash flow before we pivot to a dividend. That said, emphasize again, this is the profile we built in the 3.5 years of being listed. So, it's our objective to continue to build out the revenue profile and potentially pull forward that date.
That's all the questions.
That's great. Adam, Richard, and thank you for addressing those questions for investors today. And of course, the company can review all questions submitted today, and we'll publish those responses on the Investor Meet Company platform. But before redirecting investors to provide you with their feedback, which I know is particularly important to the company, Adam, could I please ask you for a few closing comments?
Just to thank everybody again for dialing in. We appreciate all the questions. We've really enjoyed doing these webinars, an opportunity to provide an update that's hard to articulate through announcements or or presentations. I'd encourage everybody to sign up for our news feeds. We don't bombard you, but we do like to publish announcements on meaningful news. And of course, if you're on social media, we post stuff on LinkedIn and Twitter as well. So yeah, please continue to track this. I think we're a busy company. We did 4 acquisitions last year. We expect to continue to do more this year. So yeah, watch this space.
That's great, Adam. Richard, thank you once again for updating investors today. Could I please ask investors not to close this session, as you will now be automatically redirected to provide your feedback in order that the board can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of Trident Royalties PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.